company and very minimal about the non-corporate entities. Here I will be talking more about non-corporate entities, very minimal about the companies, to suit the requirement of all of you here. So the first point which I wanted to talk about is what is the structure which we are going to talk. And when we are doing an audit, what is the expectation? Prasanna Kumar sir has actually set the tone, saying that how the regulators are looking at the auditors and how the regulators are looking at the audit function, and what is their expectation and what we are actually doing, whether there is any gap in our understanding of what we are doing as an auditor. And what regulatory framework is actually making us to comply with the requirement of various accounting standards, even when we are doing a tax audit. So our discussion will be how the accounting standards will be applicable when we are doing an audit of a client, basically a proprietor or a partnership firm, under tax audit cases, and whether we have to apply the accounting standards, and if so, what is the level of applicability and what are all the things which we have to bear it in mind. That regulatory framework we will discuss. And then we have one more additional point which we have to consider in our discussion is that peer review, if it is picked up, it is also covering the tax audit assignments. And to that extent, we should be prepared for even peer review related review for the compliance with the accounting standards. So we will discuss that also as part of our discussion. And main discussion will be focusing on tax audit and what is the relevance of tax audit with respect, relevance of accounting standard with respect to tax audit. We will have a very detailed discussion. And when we are talking about accounting standards, normally, when you said your practice is basically on partnership firms and proprietary firms, one of the normal worry which we are having is whether we will be able to understand the accounting standard in a simple method, and if that simple method is practically applied, what are all the things I have to take into consideration. So we will discuss on the special focus on the non-corporate entities and how it should be applied. We will discuss about it. And finally, we have to talk about how the compliance with the accounting standards vis-a-vis what is the audit report which we prepare. Suppose if any of you are doing an audit of a smaller company, what type of audit report consideration which you have to take into consideration? When you are doing an audit of a tax audit client in Form 3CB, what type of audit consideration you have to take into consideration? Take it to for the purposes of compliance with the accounting standard. We will discuss that. And lastly, some of the accounting standards which are basically applicable, or maybe I should say squarely applicable to a proprietary firm or a partnership firm or any non-corporate entity, we will discuss that. In fact, in the list which you have given, you are not included charitable trusts also, but I believe that the charitable trust should also be considered for the purposes of our understanding, because it is also covered as part of non-corporate entity. This is what we are going to discuss as part of our entire discussion today. Now, what is the expectation of audit? What is the expectation of auditors when you are doing an audit? If you see the entire definition which is coming in, I have picked up this definition from what we call as part of our, there is one guide which has been issued by the institute, which is saying that a practitioner's guide for audit or audit of smaller entity. So in that guide, they have defined what is an audit. So the audit is an independent examination of what? The financial statement. Financial statement of what entity? Any entity. So the moment I'm saying any entity, it covers company, it covers a partnership, it covers a proprietorship, it covers a non-profit organization as well. So accordingly, whenever we are doing an independent examination of a financial statement of any entity, again it says any entity which is profit oriented or not. So that's the reason why I said that we will even consider the implications of what would be the applicability of accounting standard when we are talking about the situation of a proprietary concern or a partnership concern, or maybe even a not-for-profit organization. So we will look into those requirements as well. Okay. So when it is profit-oriented or not profit-oriented, the next important point which is coming in the definition is saying irrespective of the size, it may be a smaller audit, it may be a medium audit, it may be a big audit. In every case, they believe that the audit has to perform the same way. In fact, when we are talking about size, they are also talking about the legal form. That is where we are talking about whether it's a company, whether it's a partnership firm, whether it's a proprietorship firm, whether it's a charitable organization, whatever is the legal form, audit is an audit. Why we are doing the audit? We are expressing an opinion on the financial statement. So now the question comes is, when we are talking about financial statement, and I do audit of only a tax audit client and not a company, whether I am really expressing an opinion on the financial statement or not, or I am just giving an opinion with respect to Form 3CD, particulars provided in Form 3CD. Please understand, if you see Form 3CB, it will carry out all the aspects of what is an audit. In fact, it says there is a fair presentation of the balance sheet, fair presentation of profit for the year. So it talks about both. And when cash flow statement is applicable, it also talks about cash flow statement. And of course, for a non-corporate entities, the size which we will be doing an audit, most likely cash flow statement will not apply. We will discuss that a little later. So when you are giving your audit report only for the purposes of tax audit in Form 3CB, still you are expressing an opinion on the financial statements. And accordingly, whenever you are doing an audit under any law, all the accounting standards issued by the institute will apply for a non-corporate entity. Accounting standard which has been notified by the Companies Act will apply to companies. So to make it very simple. So out of this definition, we are doing an independent examination of the financial statement, and even in a tax audit or even in an audit of a proprietary concern or a partnership concern, we are independently examining the financial statement of the client. Balance sheet, profit and loss account, how the balance sheet assets and liabilities have been disclosed. In the profit and loss account, how the revenue has been recognized, how the expenses has been booked. All those things are being covered in an independent examination of even audit of a partnership firm and proprietary firm. So there is no exception. If you believe that only for company I will be doing this independent examination, no. Even for a non-corporate entities, we are doing the independent examination. And if you go back and read Form 3CB, one of the paragraph will be talking about fair presentation, true and fair view of the state of affairs of the balance sheet, and true and fair view of the profit for the year. It is also there as part of our audit requirement. That means only the last paragraph of Form 3CB will say the particulars given in Form 3CD are true and correct. So in respect of particulars given in Form 3CD, you are talking about true and correct, whereas in respect of the financial statements supporting Form 3CD, you are actually talking about whether it gives a true and fair view of the state of affairs, true and fair view of the profit and loss. So even in that case also, we are actually expressing an opinion because this examination covers any entity, any activity, any size, any legal form. Okay. So activities may be profit oriented or not profit oriented. That's what we are talking about, activity. Small size or big size, not relevant. Audit is an audit because you are finally going to express an opinion on the basis of your audit of the financial statement. And accordingly, the expectation which we are having or the regulators are having on the auditors, whether you do an audit of a company, whether you do an audit of a non-corporate entity, the expectations are similar. Only difference is in a company, you are governed by the Companies Act as well. So to that extent, you are accountable under the Companies Act, whereas that accountability is not there for a non-corporate entity. But when you file your financial statement with the income tax department, where an audit is required, and you have done an audit. For example, you have done an audit for a charitable organization which is claiming exemption under Section 12AA of the Income Tax Act. In the report which you are giving, please go and check that report. There also it talks about if you are not subjected to any other audit, it is whether the financial statement gives a true and fair view of the state of affairs is also included. Whether the income and expenditure for the year is properly stated is also included. That means the regulators are expecting us not only just to fill a form and give a certification, but also to ensure that what forms the basis for that particular form, which is being filed with the income tax department, is also taken into consideration with true audit principles. That is what we have to get into that. Okay. Now, when we are talking about this case, what happens is there are some regulatory framework, as I have already discussed. Unlisted and private limited companies, directors have a responsibility based on Section 133 and 134(5), and auditors have a responsibility under Section 143(3) to report on the deviation in the application of the accounting standard. And the last one is basically the code of conduct issued by the institute, where the auditors are expected to exhibit true professional care. There should not be any negligence. And if the laws and regulations are not being followed, how the reporting should be done. That is coming from ICF Code of Conduct. But for our time being, in our discussion, we will not discuss about this Companies Act provisions in detail. Listed companies, of course, additionally added is your SEBI listing agreement. So this is additional thing which is coming in. But when you are talking about our important discussion today, non-corporate entities, it depends upon whether audit is mandatory or not. Let's take an example. There is a partnership firm, which is your client, and the partnership firm is covered by tax audit. So that means you are doing an audit. Audit may be under any law. That's what the applicability of accounting standard says. So when you say that tax audit is being conducted, it is considered as an entity having mandatory requirement for getting its accounts audited. 44AB actually says mandatory in respect of certain cases where the turnover exceeds a particular limit, professional receipts exceed a particular limit, or even in the case of presumptive taxation, like 44AD, 44AE, in whatever scenarios which you are talking about, where you are subjected to any audit, accounting standard will squarely applicable. So that means depending upon are you are doing an audit under any law, is it mandatory for your non-corporate entity? And if you are doing an audit, even under the Income Tax Act, accounting standards are squarely applicable to non-corporate entities. Accordingly, our focus today will be accounting standard, how we will ensure compliance when we are completing tax audit. And of course, to little bit, we will also discuss what is the disclosure requirement, because one of the requirement came from you is to discuss about the important disclosure which are to be added, or maybe an illustrative format of the accounting policies and the notes on accounts which has to be included for a partnership firm or a proprietary firm. For your information, I have actually shared, apart from my PPT, 2 Excel files. One is the disclosures, what is illustrative disclosure for a partnership or a proprietary firm when you are doing an audit under any law. That means tax audit also, we have, I have shared it. And I have also shared one more specific disclosure specimen for tax audit cases where the clause 13, which is talking about income computation and disclosure standard, what are all the specific disclosure? Because it talks about quantification, it also talks about the requirement of disclosures to be made. So we have given one more disclosure specimen. My only suggestion is one size will not fit to all, right? So if I have given for one of my client, it may not be exactly same for your client. Read it, edit it according to your client's requirement. You can also add something more in case if you believe that that is what required for your client. And I have already seen that all those files have been shared in this meeting itself, which can be downloaded. In the chat box, I have seen that the PPT has been shared, the 2 Excel files have been shared. All of you can download from the chat box itself and store it in your respective computers. Okay. So in that direction. The second important point when we are talking about non-corporate entities is that what is the requirement of the code of conduct as per the company, as per the Institute of Chartered Accountants of India. So we are supposed to recognize or respect the code of conduct and to follow and abide by the code of conduct. And to that extent, it is always required that we have to look into all these aspects. In fact, the previous way of looking into, sorry, I don't know, or I'm ignorant of this, will no longer is received properly by the regulator. The regulator believes that when you are doing an audit, you are expected to understand the laws and regulation, and you are expected to follow the principles which has been given in the pronouncement of the Institute of Chartered Accountants of India. And accordingly, I will suggest you that you should always ensure that you are complying with the requirements of the accounting standard when you are doing an audit of a company or a non-corporate entity, as well as abide by the regulations given by the Code of Conduct of the Institute. And you may aware that the Code of Conduct has been revised, and the revised Code of Conduct is applicable from 1st July 2020. So that is also you have to look into consideration and update on your knowledge on the Code of Conduct, because the Code of Conduct which we are having in the present form is little bit rigor compared to what we are having earlier, because a lot of new classes have been added to ensure that the compliance has been fully taken care. So you have to be a little cautious on that particular aspect as well. Now, when we are talking about peer review, previously peer review is restricted only for listed company auditors, etc., and it is not looking into others. But what has happened now is that when I am going for the peer review of a practicing unit, one of the specification given for me to select the sample of the audit client of the practicing unit to check whether they have properly done the audit or not, whether any guidance is required or not, whether we can give a peer review certificate or not. They are asking us to select even a tax audit assignment. So that means if you are simply filling a form, not applicable, nil, no, yes, so that is not actually looked into reasonably. In fact, you might have seen that there is an audit quality committee. There is a committee for quality of audit report for the tax audit alone has been formed in 2019. And very recently, they have come out with their observations with respect to the quality control or quality audit quality in respect of tax audit. That means they are trying to identify whether the tax auditor is properly doing his audit or he is not doing his audit differently. That is what we have to look into the consideration. So, sir, you cannot see in the Zoom screen, but you can see in the chat box. If you see that there is one Ongole seminar PDF file has been attached, that's a bank, and then background for Ongole seminar has been attached. There is an ICDS illustrative accounting disclosure has been attached. and illustrative specific disclosures also it attached. So please go to the chat and you can actually see that. Not in the presentation screen, you will be seeing that. Go to the chat box and you can see that. And if you are finding it difficulty, please talk to Vogel branch and they will be able to help you out in downloading it, or maybe they will circulate it for a period of time. Now, tax audit assignments is also covered as part of the peer review. What is happening is basically that the peer review statement issued by the institute is talking about two important aspects. One is, what is the compliance with the technical standards? How the practicing unit has complied with the technical standard issued by the Institute of Chartered Accountants of India. When we are saying technical standards which has been issued, it covers both your accounting standard, guidance notes issued by the institute, and finally the standards on auditing and assurance standards, or standards on auditing. But our discussion will be mainly on accounting standard. And if you see this next important issue which they have covered is quality of the audit report. Have you done your audit properly in accordance with the requirement for which you are doing the audit? For example, if you are doing the audit for the purposes of tax audit, have you properly done your tax audit is one of the review which is being done. So accordingly, compliance with the accounting standards becomes more and more important for all of us. So that is one thing which we have to keep it in our mind, that we have to take care of the entire application of the accounting standards when we are carrying on tax audit of our clients. So that is the first step which we are looking into. The second issue which we have seen is, when we are talking about the case of the peer review, the major observations which peer review board has made is basically saying that the auditors have not considered compliance with the accounting standards. So one of the important question which is being assessed and concluded is that majority of the cases where the issues have been identified it is relating to non-compliance with the accounting standard. Similarly, they are also talking about another issue which is basically not doing the audit in accordance with the standards on auditing. So in both the sides, as smaller units or smaller practicing unit will be lacking little bit. But the idea of this entire session is to ensure that what is the minimum requirement for us to ensure when we do an audit of the non-corporate entities, we are ensuring that we have taken the audit in all its requirement. And the second one, which is basically relating to that, is improper reporting, inadequate reporting, inadequate disclosure, improper disclosure. An audit is not just talking about a financial statement. That is what you have to keep it in your mind. An audit requires a disclosure also as part of the financial statement that should be enclosed by the client. And we have to ensure that the disclosure is also in accordance with the accounting standard and various regulations which is covered by for the particular client. And if the disclosures are improper or inadequate, again the auditor has to consider that inadequacy of the disclosure as part of his audit qualification. But of course, when we do an audit of a partnership or a proprietorship, we never think about doing a qualification in our audit report. Leave alone that whether we have prepared the audit report in accordance with the regulation, we never look into whether we are really thinking about qualification of an audit client. Normally, it will not apply. So we will not worry about too much on that. And this is again relating to audit report, where they say audit conclusions are not properly supported where judgmental issues are involved. Only one point I just wanted to tell you is that this area is very, very important. Why we are dragged on in legal litigations? In majority of the cases, we have done our duty properly, but we don't maintain proper working papers to say that we have carried out this particular work. So those particular work which we are carrying out, maintain proper documentation, especially to show that we have taken the proper judgments in respect of our audit of a non-corporate client or even for a corporate client, whatever is the case may be. So this is one area where we are little lacking. The documentation should be adequate, and it should be adequate to demonstrate that what is the work performed is being properly documented and kept in our working paper file. In a smaller engagement, you may ask, sir, how long I will be able to do the documentation for a small partnership for a firm or a proprietary firm just because it has come under tax audit? My simple suggestion for you is to follow one of the very good literature which has been issued by the institute. One of the publications which has been issued by the institute is a practitioner's guide for audit of smaller engagement, smaller audit. So a practitioner's guide for smaller audit is the name of the publication. You can simply Google out and you will find that publication. The publication has been very recently updated. I think it's 2019 they have updated the publication. And that publication gives you how you have to maintain a simple audit documentation to support the work you have performed. And it also gives a lot of guidance how an audit should be done for each of the category of the elements of the financial statement. For example, how you have to do an audit of fixed asset, how you have to do an audit of inventory, how you have to do an audit of trade receivable, loans and advances, cash and bank balances. It gives a lot of guidance, borrowings, capital, everything it has gives a lot of guidance. And those guidances can be given to your article students who are normally preparing the tax audit report and tax audit form 3CD after doing the audit of the information provided by the client. So creating the knowledge for your article student is also very important. Again, I am repeating, a practitioner's guide for smaller audit, which has been issued by the Professional Development Committee. Actually, it is issued by the PDC. So you can actually download it. I think Prasanna Kumar sir is one of the member and vice chairman of the Professional Development Committee. You can actually make use of that for the benefit of your professional work when you are doing an audit of non-corporate entities. Okay, so now let's move on to the frequently asked question, because this question is there in everyone's mind, whether accounting standard is really applicable to me or not. When I do an audit, whether I have to apply for a non-corporate entity or there is no requirement for me to apply the accounting standard at all. So let us look into the guidances given or the rules given for the applicability of accounting standard and why tax audit we are saying it is applicable. Let's look into this first. The first question which we are asking, whether the entity is carrying on any business or industrial or commercial activity. Suppose if your client is not carrying on any business activity, any industrial activity, any commercial activity, otherwise I can simply put that they don't have an income under the head business or profession. They have income only in the other heads, like income from salary, income from house property, capital gains, income from other sources, and not having income from business or profession, then you can simply conclude accounting standards are not applicable to that particular client. Okay. First point, the client should either carry a business activity or industrial activity or a commercial activity. If nothing is being carried out, then it is not applicable to your client. Accounting standard can be simply omitted, and you do whatever you are doing now for the purposes of your tax audit and for the purposes of your Form 3CD. The next question which is actually coming in is basically, okay, even if the client is carrying on the business, industrial or commercial activity, are they prepare a general purpose financial statement? What do you mean by general purpose financial statement? These financial statements are available for public use. Anybody can look into that financial statement, or a particular government authority can actually use it for public use. So that we call this a general purpose financial statement. For example, when we are saying we are auditing a client's financial statement which is uploaded along with the tax audit return or return of income, whether that particular financial statement is a general purpose financial statement, the answer is yes, it is a general purpose financial statement. So you have to carry out a business, industrial and commercial activity, and for that commercial activity you should prepare a general purpose financial statement. Suppose if you are preparing a financial statement only for the purposes of a project report, only for the purposes of a CMA data, for applying for working capital limits with a bank, and for that purpose a financial statement for a partnership firm or a proprietary firm is being prepared, whether that is a general purpose financial statement? No, it is not a general purpose financial statement. It is prepared for a specific purpose of raising a loan, whereas in the case of income tax it is coming under the government regulations, so it is covered by as a general purpose financial statement. Okay, I prepare a general purpose financial statement, upload with all my return of income, but for all my clients, even a small client who is having a turnover of hardly 2 to 3 lakhs, whether I have to comply with the accounting standard. Interestingly, the third condition says whether the client is subjected to audit under any law. So they have to maintain business, industrial or commercial activity and prepare a general purpose financial statement, and their accounts is mandatorily required to be audited under any law. In our case, why we are talking about the requirement? The requirement which we are talking about is only for one reason. Our client is carrying on a business activity, because of the tax audit is applicable. Or my client is doing an industrial activity, manufacturing certain products and turnover is coming out of sale of that product. Tax audit is applicable because the turnover crosses the threshold limit. Where he takes doing certain commercial activity, maybe an agency business, or he is a stockbroker, like that he is doing a commercial activity, and that commercial activity, the gross receipts crosses the threshold limit for tax audit. Because of that, the income tax return will have financial statement uploaded with the income tax department, which is a general purpose financial statement. Because of the mandatory requirement under 44 AB of the Income Tax Act, these financial statements are subjected to audit. Because of that, even for a partnership firm or a proprietary firm, or we will come to that, or even for an individual, we have to consider if it is subjected to tax audit, all the accounting standards are squarely applicable. These accounting standards are issued by the Institute of Chartered Accountants of India. We will come to that little later. Okay. So now, the question which we are having, whether I am connected to.
Sir, you are not visible, sir. Audio is visible, sir.
The problem is my power cut here.
Okay.
So
okay.
for the time being,
continue, sir. Continue, sir.
I will continue. The PPT is visible, no, sir?
Yes, sir. PPT is visible, sir.
Okay. Okay. We have the PPT, and I will continue with that discussion.
Sir.
And then later on, when the power comes in, power has come.
Okay, sir.
So, when you carry on business activity, industrial activity or commercial activity, general purpose financial statements are prepared, which are subjected to audit under any law. You have to cover it. Now, let us look into the other activities which we normally do for a proprietary unit or for the purposes of a partnership firm. What are all the other activities we normally do for our audit client? Let us look into that, whether we are supposed to consider the application of the accounting standard. For example, I issue a certificate for my client, and the client is asking for a net worth certificate or export certificate or a certificate of the investment in fixed asset for the purpose of applying MSME regulations. In all these cases, we issue certificate, right? Whether the certificate, when we are issuing, we have to follow accounting standard. Interestingly, in a certificate, we are not issuing any audit report. We are not carrying out any audit under any law. We are actually issuing only a certificate, and accordingly, accounting standards will not apply in respect of issuing a certificate for a partnership firm or a proprietary firm. The second point which we will consider is compilation of financial statement. This also we normally do. For example, a proprietary firm comes and says that, sir, I'm going for a bank loan. Bank manager is asking that your financial statement should be signed by an auditor. Immediately we put our seal, signed, and saying that extracted from the books of accounts produced to us. This is a normal thing which we are doing for majority of our proprietary and partnership clients, right? So whether in that particular situation, whether compliance with the accounting standard is required, again go by the same principle. Even though business activity is carried on, he prepares a financial statement, but the financial statement is a specific purpose or special purpose financial statement, and accordingly the second condition is not satisfied, and to that extent it is not considered for compliance with the accounting standard, especially when I am talking about proprietary or partnership. When we are talking about Companies Act requires compliance with the accounting standard, so you cannot escape from that. When we are talking about a non-corporate entity, especially a proprietorship or a partnership firm, and I am doing it only for the purposes of bank, it is a compilation work. A trial balance is compiled into a balance sheet, profit and loss account for the purposes of my audit client, and he is using it for the bank loan purposes. It is not considered as an audit, and to that extent, compilation does not require compliance with the accounting standards. So the second area of work which we are doing also not requiring a requirement. Limited review, of course, it's applicable only to listed companies, so I am not touching it for our discussion. Sometimes our client will specifically ask us to do certain specific work. For example, some of the client will say, sir, can you help us in verifying all the fixed assets? Some of the partnership firms will be having branches all over the country or maybe all over the state. They would like to have a fixed assets verification. They may say that, sir, if you are able to look into this physical verification, we will be more comfortable, and we do certain procedure for that. And in that particular situation, what we are actually doing is we have agreed with the client that we will be verifying the physical existence of the fixed asset, and there are certain fixed assets which are damaged, how it has to be removed, etc. We agree certain procedures to be applied, and based on the procedure applied, we are coming out with what is the report, whatever factually we have identified. For example, out of so much of assets which you are having in your books, so much of assets are not physically available, so much of assets is damaged and they are not usable. These are the physical observation or actual observation which we are making. The factual findings are being discussed and reported whenever we are doing such type of activity. We call that report on agreed upon procedures. There also we are not doing an audit, because the agreed upon procedure, specifically the one paragraph will be included in the report saying that we have not carried out any audit and accordingly not expressing an opinion on the financial statement. It will be very, very clearly mentioned, and to that extent, agreed upon procedure is not an audit, And when you are doing such a type of special work for your client, you need not worry about compliance with the accounting standard. You can do this method in which you are normally doing your audit, procedures for reporting to the client. And sometimes you will be doing a stock audit for a bank, inspection audit for a bank, revenue audit for a bank, concurrent audit for a bank. In those situations, what would be the requirement of accounting standard? What you are doing is a specific audit, not a general purpose financial statement audit. Stock audit, only the inventory is being verified and you are issuing your report. In a concurrent audit, whether the various parameters which has been issued as the requirement for the concurrent audit of a bank, whether the branch has complied with that. If there is any deviation, you are going to report. In an inspection audit, you are going and doing the verification of the documents for the loans issued by the bank, whether they are proper and whether they are executable in case if there is a default. In a revenue audit, you are going and checking whether the revenue leakage is available or not. So in all these cases, it's a special purpose audit and you are not doing a general purpose financial statement audit. And accordingly, the compliance with the accounting standards are not required for that type of stock audit. Forensic audit is something where the fraud type of things which has happened. And in our client scenarios, it is very, very rare to say that there is a big fraud which has happened and we wanted to check. Majority of the cases, suppose if you are any of the bank loans have become NPA and the banks are appointing forensic auditor to see whether there is any diversion of funds from the borrowed funds to any other purpose for which the proprietor or the partnership partners are diverted the money or not. That's normally a forensic audit. Very rarely a small and medium practitioner will be doing a forensic audit. And the last one is very important. We will be doing audit of many non-for-profit organization, maybe a charitable trust, maybe an educational trust, maybe some schools, colleges, or some hospitals which are charitable or hospitals. We might be doing an audit in our practice. Whether for not-for-profit organization, compliance with the accounting standard is applicable or not is the question which we have to deal with. When you see, the first condition is saying whether the entity is carrying on any business, industrial or commercial activity. Normally, a not-for-profit organization will not carry on any business activity, any industrial activity, any commercial activity. But please see, I'm using the word normally they don't use. Meaning what? Sometimes some of the charitable organization will be engaged in certain work, like they will train their members on some craft work. Whatever handicraft which has been done, it is sold in the market to raise funds for the benefit of the members. So when you buy and sell the products of your beneficiaries, there is a possibility of you are entering into a commercial activity. Because when you are buying and selling at the same price, there is no commercial activity. But normally you have to raise funds for you. For that purpose, you are also treating that as one of the stream of raising money. So in that case, there will be a profit margin. Another example which I can talk about is that we will be having a lot of cases where charitable organizations also make publications and selling the publication, raising money out of it. Some of the charitable organizations are printing greeting cards drawn by the inmates and selling that in the market to raise funds. All these activities are considered as a commercial activity. Suppose 95% of the activity is only to receive donation and make application on the charitable activity. 5% activity is to raise funds using this type of commercial activity. maybe some publication work, maybe of selling the products manufactured by the inmates. What would be the situation? In that particular situation, the next question is, whatever financials, they are actually preparing a financial statement, including a portion of the commercial activity. Interestingly, the preface to the accounting standard says that when you apply these accounting standard, you should apply even a smallest portion of the activity is a commercial activity. That means, in our example, we are talking about 95% of the activity is purely charitable activity, not for profit activity, but 5% is a commercial activity. Even with 5%, very small proportion, the entire trust has to be considered as carrying on business activity. So that means we have to look into that. You have to audit. And whether it prepares a general purpose financial statement, for example, to maintain the exemption which has been given under Section 12A of the Income Tax Act, this is preparing a financial statement and uploading the financial statement along with Form 10B. It is considered as a general purpose financial statement. And the third one is whether it is subjected to an audit. Yes, for the purposes of getting the exemption continued, 12AA registration, I am supposed to do an audit under the Income Tax Act. So even a smallest proportion of the income consists of business, industrial or commercial activity of a not-for-profit organization, and it is subjected to audit under Income Tax Act, you have to apply all the accounting standards to that not-for-profit organization as well. So that means not only partnership firm, not only proprietary firm, even for our trusts, we have to be little careful whether we are carrying on any portion of the commercial activity. In that case, you should ensure that the compliance of the accounting standards is mandatory for that NPO also.
Sir, if interest is received,
okay,
interest and activity, yeah.
So purely interest is received by the not-for-profit organization. Let us look into that interest which has been received. For example, if the interest is arising out of fixed deposit of the surplus funds or earmarked funds, we are putting in fixed deposit, or endowment funds, we are putting in fixed deposit. Those interests are not business activity, industrial activity and commercial activity, because it's not a business income at all. On the other hand, suppose if I'm saying there is a not-for-profit organization, it is also helps a certain group of its members, for example, a self-help group, and it is doing some microfinance. So that means it gives a small loans to its beneficiaries and takes interest for the loans given. Then it's a business commercial activity. So you have to see interest income is arising out of fixed deposit or arising out of loan activity which is being carried out by the entity. If it is a loan, then we will say that you are actually entered into a commercial activity. It is not income from other sources, right? That is the way in which you have to see the interest income, sir. Now, moving on to this next important discussion, tax audit and accounting standard. What is the frequently asked questions? Whether it is applicable is the first question which is applicable, which is being asked, for which we have already discussed. Yes, for tax audit cases, you have to comply with the accounting standard that we have already seen. Now, what are all the other questions? One thing is, this is a normal question which everywhere we are talking about this, we are asking the question, sir, I have only tax audit. Whether, and tax audit is also for a partnership firm and for a proprietary firm. So whether I have to comply with the tax audit, I believe that it's not, whether I have to comply with accounting standard, I believe that it's not applicable. It is applicable only for companies. Please understand, based on our discussion, which we have done in detail in the previous session, the previous slide, tax audit requires a compliance with all applicable accounting standards. Okay. The next question normally comes in. Sir, accounting standards, when you are talking about, income tax department has also notified accounting standard. We call that as income computation and disclosure standard. When we are talking about income computation and disclosure standard, in tax audit form, clause 13 of the form requires me to disclose certain matters in accordance with income computation and disclosure standard. Is it sufficient that I am complying with the income computation and disclosure standard or ICDS and not going for the accounting standard issued by the Institute of Chartered Accountants of India? Is it okay? Unfortunately, if you see, the answer is no. It is not enough just to comply with the ICDS. The reason is very simple. If you read the name of the standard, Income Computation and Disclosure Standard, it is not an accounting standard at all. It is only giving a guidance how you have to compute your income under two heads of income. Income from business or profession, second income from other sources. Only for that two heads, ICDS is applicable. That too, how you have to compute and what is the disclosure which you have to make. That is exactly what is the requirement. That means the accounting standard which we are talking about is not at all coming as an ICDS. That means you have to follow accounting standards for the preparation of the financial statement and follow ICDS for the purposes of computing your taxable income under the head business income or business or professional income or under the head income from other sources. So it is not enough just to comply with the ICDS. You have to comply with both accounting standard as well as ICDS. This is another important aspect which you have to keep it in your mind. Now, what is the applicability of the accounting standard? When we are talking about applicability of the accounting standard, what exactly is the applicability of the accounting standard? I'm just giving for a basic understanding. However, we will be discussing only about this non-corporate entities. In respect of non-corporate entities, your vice chairman has actually started in his initial discussion. For a non-corporate entities, the accounting standard issued by the Institute of Chartered Accountants of India will be applicable. So, when you carry on a tax audit for a proprietary unit or a partnership unit, you should comply with the accounting standard issued by the Institute of Chartered Accountants of India. That means there are other set of accounting standards are also there, which we will just, for academic sake, we will look into that. One is general companies. You have to follow the accounting standard as notified by section 133 of the Companies Act. Companies Accounting Standard Rules 2006, which has been amended recently in 2016 also. That is only for companies. So if you are looking for non-corporate entities, look for accounting standard issued by ICAI. And there is one more set, maybe majority of our clients will not get into that, Ind AS. That means where the net worth is more than 250 crore. Net worth, share capital and reserves and surplus, more than 250 crore. Or it is a listed company. Then they have to follow a separate set of accounting standard. We call that as IFRS Converged Indian Accounting Standard or Ind AS. So we will not have any discussion with respect to the general standards which are applicable for a non-corporate, for a general companies, but we will discuss what is the standards which are applicable when we are talking about standards issued by the Institute of Chartered Accountants of India. So this is what we will discuss for our discussion today. And even though it is applicable for companies, this will be for companies. So we will not discuss this. And this is for listed companies and for net worth exceeding 250 crore, and accordingly we will not look into that particular aspect also for our discussion today.
Sir,
So we will be discussing. Yeah.
Sir, one question, sir.
Yes, sir.
Sir, this Ind AS, these accounting standards are prepared by the MCA or ICAI?
Okay.
ICAI notified by MCA or prepared and notified by the MCA?
Okay, good question, sir. Actually, all these standards are prepared by the institute. Whether I'm talking about non-corporate entity or general purpose companies or Ind AS, all are prepared by the institute. But the authoritative status comes in on the date of notification. Who notifies? Only in the case of this, ICAI notifies the standards. For non-corporate entities alone, ICAI has the authority to notify. For general companies as well as this, MCA has the power to notify. So standards are prepared by the institute, but notification is being made by the Ministry of Corporate Affairs as part of the Companies Act 2013. And accordingly, except non-corporate entity, standards are prepared, notified by the institute. For other things, basic preparation is being done by institute, and then it goes to the Ministry of Corporate Affairs for their comments, and finally it is being approved. Now,
Sir, then there are two set of standards. For example, accounting standard 100 will take. So accounting standard 100 will be same for the Ind-AS companies and also for non-corporate entities, or there will be a difference accounting standard for 100 for non-corporate and corporate. Different standards will be there.
okay, okay. That is exactly you are seeing on your screen, sir. There are 3 sets of accounting standards which are presently available. One, what is the accounting standard which are applicable to a non-corporate entities, which is prepared, set and notified by the Institute of Chartered Accountants.
That is okay, sir. For example, accounting standard 1, you take the basic principles. So AS1 for the non-corporate will be different, and AS1 for corporate Ind-AS will be different, or both will be the same.
Coming to that, I am coming to that, sir. I am coming to that. Thus, Ind-AS 1, AS1 for companies, AS1 for non-corporate entities. The question is whether there will be a difference. Yes, there are differences. That is the reason why
we have to read separately, sir. For Ind-AS, we have to read separate accounting standards, and for non-corporate entities, we have to read separate accounting standard. Number will be the same.
Correct, sir. Number will be same, and sometimes the matter will also be different. For example, I will tell you what is the number and then what is the standard. When we are talking about AS1 for non-corporate entities, it is accounting policies. For general companies also, it is accounting policy. When you are coming to Ind-AS, this is talking about presentation of financial statement. What is the format of the financial statement is what is Ind-AS 1. And accordingly, number may be remaining the same, but the topic itself will be different also. So you cannot simply take a view that accounting standard 1 means it will be same accounting standard in every case with some small differences. So that is the reason why I wanted to say that there is separate set of accounting standard. For example, accounting standard 1 to accounting standard 29, separately available for non-corporate entities, separately available for general companies. When separately available for general companies, there will be difference between that standard and what is applicable to non-corporate entity standard. We have to understand the difference, and accordingly we have to apply. So you have to read both, sir.
Okay, sir. Can you explain briefly, sir, accounting standards now in this program?
We are going to discuss a little bit, sir, on that.
Okay, sir. Thank you, sir.
Okay. So now what you are asking about the accounting standard for companies, accounting standard for non-corporate entities, I should touch upon briefly Companies Accounting Standard Rules 2006. What this rule says is Companies Accounting Standard Rules is applicable for companies, and accounting standard issued by the Institute of Chartered Accountants of India is applicable for non-corporate entities. That's what we are discussing here. And as I have already mentioned, before coming to the slide itself, that question has come. So we have discussed that. So this is the standards which has been issued by the Institute for non-corporate entities. Okay, the next will tell you that this is applicable to non-corporate entities. Whereas Companies Accounting Standard Rules 2006 is actually notified as per the Companies Act. If you see that it is notified under the Companies Act. And to whom it is applicable, because it is notified under the Companies Act, it will not apply to a non-corporate entities. It will be applicable only to a company. Okay. Now that is the big difference. What is the difference between the accounting standard which has been notified by institute and what is notified in the company's accounting standard rules? They have classified the entities itself into different categories. For example, in this case, we have level 1, level 2, and level 3. There are 3 categories which have been classified for non-corporate entities. What is level 1? If the turnover is more than 50 crore and if the borrowing is more than 10 crore at any point of time, that is considered as a level 1 entity. So you have to see whether any of your partnership client has a turnover of more than 50 crore or they got any loan of 10 crore, because some of the partnership firms will continue to be a partnership firm even after they have come out with a very huge loan, or maybe their turnover has crossed bigger limits for operational convenience rather than coming into the company's situation. Only they will be interested in becoming a company where the bankers are saying, I will not be able to give loan for a non-corporate entities beyond this level. So you have to convert that into a private limited company. Then only they will go for a company. What is this level 1? As I have said, 50 crore turnover or 10 crore borrowing, that will covered in level 1. For level 1, all the standards will be applicable.
Sorry,
level
sir.
2?
Speaker, sir.
Yes, sir.
Vijay Kumar sir has joined, sir. Now we will have a question and answer session, sir, now for him.
So he is going to speak now?
Yes, sir. Yes, sir.
Okay.
We will continue after 10 minutes. We will continue the presentation.
Okay.
No. Rajendra Prasad, Vijay Kumar, good evening to all. The schedule I have been told is Mr. Chinnsamy will complete his presentation and I will participate in the Q&A session last half an hour. So I'll wait. There is no problem. Let Mr. Chinnsamy finish his entire presentation. I'll wait. Sorry. Is it visible?
No, sir.
Now visible, sir.
Now you are visible, sir.
Okay.
Now
so
you are visible, sir.
let Mr. Chinnsamy finish his presentation. I will wait. I'll wait. After his presentation is done, we'll take the Q&A, 15 minutes, half an hour, whatever time. I've kept myself free. So whatever time it takes, I'm available. So let the flow of presentation not stop. I'll wait.
Okay, sir.
Okay, sir.
And I'll get the opportunity of listening to Chinnsamy once again.
The third point which we have to consider with respect to companies accounting standard rules 2006 is basically, it talks about only 2 levels. Okay. So, before we coming into the company's accounting standard rules, level 2 of accounting standard applicable to ICA, all our tax audit clients will fall into level 2. Because of that, so you will get caught into that particular scenario. They were talking about 40 lakhs of turnover, which was the turnover of tax audit limit up to one particular point of time. Now it is revised. So this is into level 2 category. In level 2 category, all our tax audit clients will get covered. And for them, this standard should be, all the standards applicable as issued by the institute should be applied when you are preparing your tax audit situation. For companies, it is actually level 1 and level 2, or maybe I can say that it is actually talking about small and medium company and non-small and medium company. There are 2 categories which has been given here. This is first category, this is second category, based on which we will apply this. And if you see the application of the accounting standard, even for non-corporate entities, normally the relaxation is given only with respect to the disclosure and disclosure principle and not on recognition principle. That's what I would like to say. This is on companies accounting standard rules. Let me just move on to the non-corporate entities and the accounting standards, where you wanted to understand the compliance requirement. Please see that. Somebody has asked the question about what are all the standards which are applicable and how I have to apply. This gives a single slide presentation of For level 1 entity, what is applicable, level 2 entity, what is applicable, and level 3 entity, what is applicable. Majority of our tax audit clients will fall in level 1 or level 2. So accordingly, you should be able to understand that these are all the things which you have to apply. These are all the standards which you have to apply.
Sir, can you tell again what is level 1, 2, 3, sir?
Sorry?
What is level 1, level 2, and what level 3? Can you explain again?
Sir, level 1, level 2, level 3 is based on the turnover and the borrowings it has been classified. And level 1 is 50 crore turnover and 50 crore turnover and 10 crore of borrowing. And level 2 will have more than 40 lakhs of turnover and also borrowing of 1 crore and above. And level 3 will be less than that. So level 3 will normally be a very small entity. So this very small entity, you will not even have a tax audit. So accordingly for them, even though we have the list, you will not be carrying out any audit under any law. So it will not be applicable for a proprietary unit or a tax partnership unit. But level 2 will definitely get covered because of the threshold limit of the turnover. And level 1 will also get covered because of the threshold limit under tax audit. Both of them will be covered under tax audit. Because they are covered under tax audit, they are supposed to follow all the accounting standard. So when they are supposed to follow all the accounting standard, the accounting standard applicable is accounting standard 1 to 14 and except 3. Except 3 means 3 is a cash flow statement. It applicable only to level 1 entity and not applicable to level 2 entity. Again, all other accounting standard 15, 16, 19, 20, 22, etc. What is not applicable, in fact, is given when you are talking about related party transaction also is applicable to level 2 entity, but not applicable to level 3 entity. Level 1 entity is also it is applicable. But when you are seeing consolidation standard, normally a partnership firm or proprietary firm will not prepare any consolidated financial statement. And accordingly, for a non-corporate entity, theoretically, if they prepare a consolidated financial statement, we call that as a combined financial statement. In that case, the principles may be applied. But I normally believe that this will not be a case where we have to worry about it. We have to only worry about the other accounting standards. That is what the prescription given. The practical approach which I am talking about with respect to the accounting standards, basically use a checklist approach. What do you mean by a checklist approach? Prepare a simple Excel sheet documenting accounting standard 1 to accounting standard 29. In the next column of the Excel sheet, put name of the standard. Third column, whether it is applicable to your client or not. For example, there is a standard called AS7. This AS7 is applicable only for construction contracts. Okay. If I don't have a construction contract, there is no need for me to apply AS7. If my client is not into construction contract, they are manufacturers, then in that case, AS7 can be simply said that not applicable. The moment you put the not applicable, the next column I normally say is that what is the requirement under that particular column, key focus areas, put that in the next one and give the instruction, what is the audit procedure to be done to your audit team. And the next column, what is the work paper reference? The last column, have you verified and cleared that work paper? Prepare a simple checklist for the purposes of doing the entire work. I am saying prepare that at the planning stage itself, whether it is applicable or not. The second interesting point I normally wanted to say, this particular accounting standard is linked to which financial statement line item. For example, if you are talking about AS10, I will say that it is applicable to property, plant and equipment. And if the client has only certain furnitures, fixtures and office equipment, not great property, plant and equipment, I can say that the focus for this is very limited. Similarly, I have a standard called AS9. There is a standard called AS9 that is talking about revenue. Okay, so the moment the client has turnover, this particular standard is applicable. For the turnover, what are all the things which you have to look into? Like this, you please link the accounting standard with the financial statement line item, both for the balance sheet and for the P&L item, and tell your team what is the focus area. That is the audit strategy which we are talking about. And in the completion stage, what is the work you have performed? Have you complied with the accounting principles given in that particular standard? And if so, after that, whether it is properly presented in accordance with the requirement of the accounting standard, and what is the disclosure requirement under this particular standard, whether the disclosures have been properly made or not. And of course, this audit report consideration, whether you have to bring reference to any qualification in the auditor's report, that is actually given in this flow chart. Basically, it will be more applicable for a company. I believe that in respect of a partnership firm or a proprietary firm, when you do a tax audit, most unlikely that you will be qualifying your audit report. But for academic sake, I will let you know only two statements. The qualification comes on two accounts. One, with respect to accounting policy as per your accounting standards. That is one. And disclosures required as per AS. This is the two areas which they are saying. If the important disclosures are missing, if the accounting policies are not properly applied in accordance with the accounting standard, then you have to necessarily think about qualifying it. When doing this particular aspect, one of the important aspects which you have to consider is it material? That is very big number. For the time being, I am not defining what is material, because material means I have to go into standards and auditing. Maybe I can put it in a simple terms, 5% profit before tax are may be considered as a material. If any of the errors are less than that 5%, you can say that you need not even consider the non-compliance with the accounting standard, because the preface to the accounting standard says very clearly, if the impact of the accounting standard is not material, you need not comply with that particular accounting standard, because accounting standards are applicable based on the concept of materiality. This also you can keep it in your mind. And in case if you wanted to have a quick look on the standards, I have given the standard for various standards I have actually picked up. For accounting standard 1 on disclosure of accounting policy, accounting standard 2 with respect to the estimation of the cost or net realizable value, where we normally miss it. And there is also another issue which we are having, is that how we are allocating the overhead cost to work in progress and finished product. Especially the fixed cost has to be allocated based on the concept of normal capacity. In a COVID-like situation, there is a possibility that the production is below the normal capacity. And if it is below the normal capacity, fixed cost should not be allocated based on actual production. That means your inefficiency is being supported by means of inflation in the value of closing stock. That is one of the point. I have just picked up those standards which are normally applicable to a non-corporate entity. And the third one which I wanted to talk about is, some of your clients will be doing construction contract. They may be contractors who are constructing buildings or any other hospitals, malls, etc. for your other clients, and not real estate developers. I'm talking about construction contracts, or they may be manufacturing special purpose machines. In those cases, this standard has to be applied, where it says that you have to apply percentage completion method and not completed contract method. So that is what you have to look into. Only where ICDS is having a different scenario. AS10 talks about property, plant and equipment, and whether depreciation claim is two things. Whether it is optional is one question, and another is during the COVID I have not worked. Can I defer my depreciation is the second question. Whether I can defer the depreciation is the second question. First question is, it is not optional. you have to necessarily charge depreciation according to AS 10. And secondly, when you are coming to depreciation deferral, during the ideal period of COVID, whether for 3 months I will not charge depreciation. Only possibility is if the client has extra shift depreciation, double shift or triple shift they are working, for which they are charging additional depreciation according to accounting standard 10. Because the factory itself is closed and it is not opened. So the second shift and third shift depreciation can be avoided, but the single shift depreciation has to be necessarily charged because depreciation is not based on just usage, but also because of efflection of time. The other possibility is, suppose your client is in the manufacture of some items using some molds or dies, where the molds and dies are capable of manufacturing some number of products, based on the unit. Say for example, a particular mold will be used for manufacturing 1 lakh pieces. So your depreciation will be up to 1 lakh pieces. So mold cost will be divided by 1 lakh into charged with the number of units produced. So those unit of production, there is a possibility of deferring the depreciation in respect of COVID situation, but the single shift depreciation you cannot avoid because it is not optional under the Act. Having said that, you should also see that under the Income Tax Act, the depreciation is covered by Section 32, block of asset method. And you should also see what is the impact arising out of these two differences, because income computation and disclosure standard, we have a standard on tangible fixed asset. What that standard says, what is the impact of that with respect to fixed asset, and what is the amount which you have charged in the profit and loss account. One normal question which is coming in is, can I charge the depreciation in accordance with the Income Tax Act itself and put that as part of my P&L depreciation in respect of a non-corporate entity? We have seen cases where the depreciation impact both under the Income Tax Act as well as per the accounting standard 10 is not materially different, and accordingly, even if you wanted to avoid that, it is okay to charge this. Because of materiality, it is possible. But if the difference is significant, then you have to follow different depreciation principle as per AS 10 in books and under the Income Tax Act as per your tax audit calculation. And of course, employee benefits, actuarial valuation for gratuity and leave encashment, you are having certain exemptions for smaller entities. For example, it says if the number of employees are less than 50, you can get an exemption from taking an actuarial valuation. For non-corporate entities, there is an exemption which is available. That exemption, you can actually use it. But only thing which I'm normally finding as a problem is the base data given for actuary is not being done. Very recently, we have done one tax audit. It is not a corporate audit. In a tax audit case where we were verifying, all in a sudden the company's incremental rates has been brought down dramatically by 50% of what they have considered. The reason why the company was it's not a company, it is the partnership was actually making losses, and for bank purposes they wanted to show a profit. For income tax purposes, they are having carry forward losses. They are not bothered about the taxes. So what they wanted to do is a lesser depreciation in the book, lesser charge to gratuity in that, but they are having more than 1,500 employees in their role, even though it's a partnership firm, a very big manufacturing unit which is run under the partnership family business. So in that particular situation, when they are coming out with this particular number, actuarial valuation, we have only checked what is the data used by the actuary and what is the assumptions taken by the actuary. When we have checked that there is around the 50 to 60 lakhs reduction in the gratuity amount to be charged in the current year compared to the previous year, mainly because their incremental rates have been taken 50% of the previous year assumption. When we have asked why, they said that we are not going to pay increment because of COVID-19 situation. Perfectly all right. Whether it is a permanent decision or a temporary decision, it may be for next 1 year, not for the entire year. So on that basis, permanently whether you are going to maintain this or you are not going to maintain this, when we are asked the question, actually has said that yes, this assumption is coming with a wrong assumption. Temporarily, this difference is coming in, but not on a permanent basis. our actuarial valuation should be on a permanent basis. They have revised another 50 lakhs we have debited to the P&L account. Why I'm saying that is validating the actuarial assumptions and validating the base data given to the actuary is an important point. Of course, borrowing cost accounting is another important area where we have to look into.
Sir, in case of AS 15, if the company is a small one and if we are satisfied with the provision provided by the company, still actual valuation is mandatory, or we can go ahead based on the materiality and other circumstances of the company.
Good point, sir. That's what I have mentioned. You have to go with the number of employees of the particular company. Suppose if the number of employees of the particular company, partnership is lower than 50. If it is a company, you cannot do it. If it is a partnership or a proprietorship, if the number of employees are less than 50, in that case, you can take the actual valuation. That is, client makes every half a month, 15 days divided by 26 into last drawn salary. You can use that. Actual valuation is not required. In a company case, that particular exemption is not available. That is the only reason why we have to go for an actuarial valuation. The one normal question comes in a smaller company case is, can I depend on the actuarial report given by the LIC with whom I have maintained this? I normally say that this impact is not significantly differing, and accordingly you can go. Because of the concept of materiality, you can take the LIC valuation for a smaller company and recognize that particular situation. For a bigger company, independent actuarial valuation may be required. In your client case, you can simply go with the actual valuation done by your client. Not an issue, sir. And when we are coming to the disclosure part, my suggestion is please go to the disclosure which I have given as a illustrative, which is a non-corporate entity, partnership or a proprietorship. And if there are any questions, I will be happily take that questions. And I have also given you a disclosure requirement based on ICDS, illustrative disclosure. What is the specific disclosure required under ICDS? What is the specific disclosure, a non-specific disclosure or general disclosure required under ICDS? You can actually look into that as well. And if there are any questions after, say, MP Vijay Kumar is making his additional comments, I will take the questions along with him if any questions are coming in over to the organizers so that you can actually give the session to the safe hands of Mr. MPV.
Thank you, sir. Thank you for your presentation, sir. Now, I request the Jagan Mohan Garu to present the MPV, sir, for the members.
Good evening, all the members of Ongole branch. I am very happy to present our Central Council member, MP Vijay Kumar, to the Ongole branch members. And giving me this opportunity, I am very happy. And now the profile of MP Vijay Kumar, he has qualified as Chartered Accountant 27 years ago. Since then, sometimes he has served in industry and presently he is in practice. He has elected directly to Central Council in the year 2016 without entering into either branch or through regional council. Again, he has elected to the Central Council with thumping majority in the year 2019 for 3 years term up to 2022. Presently, he is chairman for Accounting Standards Board of ICAI for the period for 2019 to 21. Previously, he worked as chairman for Valuation Standards Board during 2018 and 19 and Digital Accounting and Assurance Board during 17-18. Presently, he is vice chairman for Expert Advisory Committee for the period 2019 to 21 of ICAI. Recently, he has nominated to the Accounting Standards Board as member for the period 2020-21. He is also nominee member of NEFRA as ex officio. He is also a member of IFRS Advisory Council. He is presently committee member for several boards of ICAI. He has several work experience. He is presently CFO of SIFI. Previously, he worked in Sundaram Finance as head investment banking and company secretary for about 7 years. He has authored several books which are useful for professional members as well as students. Presently, he is director for XBRL India Limited, SIFI Singapore Private Limited, Teja Engineering Limited, Cella India Software Services Private Limited, and he is a former director of National Internet Exchange of India. He got several awards, that is from Capital Foundation Society National Award towards contribution to financial accounting, and CFO India Top 100 Roll of Honor, and he got award from SEMA as 100 most influential CFOs in India. I thank you very much, particularly Vijay Kumar Garu, to present his profile and Ongole branch also. Thank you very much, sir.
Namaskaram, Jangar. Thank you for those kind words of introduction. My sincere thanks to the chairman, managing committee of the branch for having invited me to address or be part of this session today. I'm extremely happy that we had the support to soil Prasanna Kumar Garu do the inaugural, and we have Chinnamastan, who's been extremely supportive for the activities of the branch from the region. And thanks Chinnsamy as usual for your wonderful articulation and lucid presentation. And on behalf of the profession, thank you for the time which you gave for the institute. I will speak probably for about 6 or 7 minutes, and I would like to actually spend most of our time on the Q&A. I'd like to, there were some interesting questions also which came up as Chinnsamy was speaking. I would like to keep it more interactive. Before I share my 5-6 minutes of thoughts, add a disclaimer that whatever I speak are those of my individual views as a professional, and none of what I speak should be treated as views of the council of the institute or any of the committees or board of which I am part of. So as far as the accounting standards, what Chinnsamy spoke almost an hour, at least I heard him for half an hour, what he spoke. These standards are currently under revision, as these standards were issued largely between 1980 and 2001. So the 27 standards we have, except AS10, which got replaced with the revised AS10 in 2016, all the other standards have been issued between that period of 1980 to 2001. Some of the standards are almost 40 years old, some of them are 30 years old, 20 years old. And each standard, the way it evolved in a different form and shape. Half of these 27 standards were issued prior to 1998, and half of them got issued after the Major Companies Act amendment in 1998. And these accounting standards, and I'm speaking only on accounting standards, I'm not speaking on Ind AS, which is applicable to larger corporates. And these accounting standards as we speak, and one of the members had this query, these accounting standards which are issued by institute for non-corporates and notified in the Companies Act for companies below 250 crore net worth, fortunately are the same. At one point in time, on a matter of concept, we had a stronger concept or principle for non-corporates and a diluted one for the joint stock companies in the context of foreign currency exchange differences. But eventually that relaxation was done even for non-corporates. And it is very important to realize that there are lots of non-corporates whose sizes are much bigger than those of companies. They're much bigger than those of companies. In fact, there are non-corporates like, for example, the Airport Authority of India, who has a balance sheet size of 40,000 crores. And today, if we look at banks and insurance companies, they all follow the accounting standards. And if you look at cooperative banks, which are fairly large in size, balance sheet size is big, and there's a lot of public interest, they follow the accounting standards issued by the institute. And we are all aware that post the liberalization of 1990s, and more particularly in the last 20 years, there's been huge change in the business environment and the economic environment. And the principles or guidance in the accounting standards has not been found to be adequate. Also, with startup ecosystem, now we have lots of private companies, 1 crore, 2 crore startup ecosystem, which are all small. But in the case of startups, ESOP, the employee stock option plan, is very, very common. And currently we don't have an accounting standard on how to account for stock options. Instead, we have it in the form of a guidance note, which is currently under revision. Most likely the revised guidance note will be issued sometime soon. Having said this, last year at the Accounting Standards Board and at the Council also, we noticed that there were many non-corporates who were very small in size. 1 crore turnover, 2 crore turnover, 5 crore turnover, largely trading activities, preparing financial statements largely for tax audit. And these entities by law were required to comply with accounting standards. And we found that the size of the publication actually put off people. So the idea is to see if we can. We are evaluating. I reiterate, we are evaluating, no commitment as yet. We are evaluating whether we should have a third set of accounting standards, which will be a simpler version of the current accounting standards. And the idea is, if something is simple, the compliance will be high. As Chinnsamy was mentioning, that level 2, level 3 in particular, there are lots of small businesses which are there. So if we can give them a simpler document, it will be easy. And we all know that getting staff, whether at preparer, at the business side, or even in the audit firm, to apply the accounting standards is difficult. So if we make it simpler, probably the BCom, MCom, they will all be able to easily understand and apply these standards. In fact, as far as non-corporates are concerned, of the 27 standards we have, there are hardly about 11 standards which actually are applicable for these non-corporates. And all these 11 standards are something which is fairly simple, and everyone here in today's webinar are very familiar with this. For example, a standard like Accounting Standard 1, it says disclose accounting policies. We all know there is an ICDS also. There are standards where with very negligible effort, you can comply. Inventory, AS2, cost or NRV. AS4, event after balance sheet date. 5, important one because for non-corporates like joint stock companies, we don't have a format of financial statements. So for non-corporates, how the item should be presented, the only guidance available is in AS5. Ordinary, extraordinary, exceptional, prior period, change in accounting policy. The only guidance comes in AS5. AS9, recognize revenue, goods, services, other income. 10, property, fixed assets, how much to capitalize. 26, if there are intangibles, non-corporates will at best have software. So if you buy software, capitalize it. That's all. Very little effort, these standards can be followed. And depending on nature of activity, if I'm in construction activity, then I need to recognize income percentage of completion method AS7. But ICDS also asks us to do it. And we have AS22 on deferred tax. Looks complex, but very simple if the concept is understood. I have not found a simpler standard than that, but until concept is understood. AS15, employee benefits. Smaller organizations, provident fund actual contribution. There was a query from a member and Chinnsamy just answered. If you have less than 50 employees, gratuity you can actually calculate on actual basis. Otherwise, get an actuarial valuation done. AS16 will apply if you have borrowings, and smaller organizations are unlikely to have borrowings, projects, capitalization and all. The remaining standards, most of them are not applicable, like cash flow, amalgamation, segment reporting, consolidation. They're actually not applicable. And there are few standards which may become applicable otherwise. So effectively, there are only about 10 to 11 standards which apply for non-corporates. And if you filter out standards like AS16, where you capitalize only if you have a project, etc. If you remove those kind of standards also, hardly 7 or 8 standards to comply. I just want to bring to your attention, and I saw Rajendra Prasad Garu publish it in the chat box. There's a publication from the Accounting Standards Board 2 years back called Quick Referencer. It's a 90-page publication, but in A4 size, it's only 45 pages. All the 27 accounting standards have been beautifully put into that 45 pages, and I would encourage all to go through it. More particularly, request your staff to read the same. There is no need to read the whole document. If you read that quick referencer itself is more than enough to get an understanding of what the standards are. I keep giving this example. The accounting is very simple if the transactions are simple. And the accounting requires a detailed guidance if the transaction is complex. And if you look at most of the small, medium enterprise we do, all those cases, the transactions are simple and accounting is very simple. The standards have those extra paragraphs and guidance because there are few enterprises who actually do those kind of complex transactions. I'll give you two very simple examples, very simple examples. Example one. There are many senior members here and they would bail me out. 10, 20 years back, when somebody were selling a product of 5,000, you sell a product of 5,000, invoice 5,000, revenue 5,000, income P&L, life simple. But today, almost every product you sell comes with a 3-year warranty. So the same product is sold for 5,300. So invoice is for 5,300 and you have given a 3-year warranty, which means you have undertaken an obligation that if that product gets repaired, damaged, whatever, next 3 years I will repair it. So your 5,300 is not your entirely your income. Part of that, you have to hold it back as provision to meet those probable repairs. So during the year, I sold so many units. I expect so many to come back. I expect so much one. So that's where accounting requires guidance. So if you sell it without warranty, life is simple. But the moment you do a complex transaction, to ensure uniformity, comparability, matching concept, etc., you require that additional guidance. I'll give you one more example, which is again from what I had personally gone through last year. I'd gone to buy, and it's from a small shop, it's from a small shop. We are not talking about large corporates and all. I'm talking about very small shops. I had gone to a spectacle shop to buy glasses for my daughter. So I bought a glass spectacle frame or whatever for about 900 rupees over. And as I was coming closer to the billing counter, the salesperson tells, sir, there is an offer. You buy for 1100 rupees, you'll get one more glass frame. I told him, look, I don't want now, I'm happy with this. He said, you need not buy now, but you pay 1100. Within the next 1 year, whenever you want, you can come and whatever you buy, you'll get the 200 rupees adjustment done. And he went on to explain, saying that depending on the dress matching, etc., you can have different frame, all that. So a very small shop was trying to increase the per customer sale value by making a sale with loyalty rights. So out of 1100 rupee income, invoice of 1100, only 900 is income now, for which there's a cost and profit. The balance 200 is consideration for a loyalty right you have given. That 200 is not your income now. You have to segregate it and account later. Small businessman also understands this. That is why he introduces these products. He knows if 100 customers buy, only 30, 40 will come and he will make the profit, cover it up, etc. and all. So those transactions, how do we account? At a very simplistic level, while the standards as volume will look huge because they try to give guidance for every situation. If accounting transaction is simple, the accounting is extremely simple. Only when it gets complex, guidance is required. From the institute, we have this publication called Quick Referencer. There's a disclosure checklist which you can do a checkbox. Chinnsamy was also mentioning, when you complete each audit, you can do that checkbox. And there's a publication of the Financial Reporting Review Board, where it highlights common non-compliances. So that common non-compliance, again, a very simple publication. There are 3 volumes published so far based on reviews. That publication, when you read, you can avoid those similar mistakes to happen. And in the Digital Learning Hub, which all of you have access, there's a 20-minute video for each of the accounting standards. I would encourage that these knowledge initiatives, make it available in particular for the staff, whether they're article students or paid staff, make it available to them because it is they who actually do the work. And if they get trained, the quality of work will also improve. I just want to add on to one of the questions which had also come up. And there is this wrong, there's not this proper understanding which has evolved over a period of time. And I would like to clarify for benefit of all. As far as accounting standards and auditing standards are concerned, by law, that is under the Companies Act, they are formulated only by ICI. The standard setting power under law is only with the Institute of Chartered Accountants of India, that is us. That power remains with us. The purpose of notifying this under Companies Act is whatever standards institute formulates, it is binding on its members. But the same standard, we should make it binding on preparers of financial statements, that is company, the board of directors, audit committee, the CEO, CFO, you should make it binding on them. That power to make it binding comes only in Companies Act. Institute cannot tell directors of those companies how to follow my standards. That power is not available with us. So for this reason, the power of standard setting is only with the institute. It is the institute who will decide whether to issue a standard or not to issue a standard or whether to amend or not to amend the standard. That power is only with the institute. To make it binding on preparers, government notifies under Companies Act, but government requires a consulting body who will advise them independently, and hence they have this body called NFRA to advise them, which is a body which replaced the erstwhile NACAS. In these times, which is particularly the COVID times, when we are seeking to enhance stature and respect of profession, quality of accounting standards and auditing standards, and compliance with same is extremely important. Each of us here are very sensitive to the stature of the profession and the respect of the profession. And we are all cognizant that actions speak louder than words. Actions speak louder than words. There is a general concern among the stakeholders, be it regulators or users of financial statement, that compliance with these standards is low. Each of us here in this webinar and the profession at large have an individual and collective responsibility to change that perspective in the larger interest of the profession, and more importantly, in the interest of the young and the next generation of chartered accountants who should get global opportunities, and the young and the next generation of CAs should never be placed below the peers across the world. India is already the hub, and it will become a much larger hub for accounting and audit for the world. Mark my words, mark my words. It could be 5 years or 7 years, but it's not far off when an audit firm sitting out of Ongole can actually do audit of a company incorporated in Germany, which is listed in the US Stock Exchange. That will happen. So given the pace of digitalization which is happening, it just doesn't matter whether somebody is sitting out of London office and doing the audit, or Singapore office, or a Mumbai office, or an Ongole office. It just doesn't matter. All of us come through the same course and have access to equal opportunities. It's just that we need to position ourselves for that. From government side, there are 12 sectors identified for export of services. One of those 12 is accounting services. And the institute has a specific committee which is focusing on building those capabilities for export of services. Export can be like IT industry, people export, or like the same IT industry. You have the offices in India. Gurgaon, there are at least 50,000 people working, Gurgaon, who all do accounting services for the Fortune 500 companies across the world. Specific to COVID, on accounting, there are 2 items I'd like to highlight. One, for some of your clientele who have 100 employees, more than 90% of them have salaries below 15,000. The PF is contributed by the government, employer contribution. So that contribution will be treated as a government grant. Similarly, there could be some company audits you must be dealing. And in the case of companies, if there is a CSR applicability, if CSR is applicable, the government in April 2020 has issued a notification that contribution to PM CARES in financial year 2021, you can take credit for income tax computation, liability computation in financial year 1920. So such case, you need to create a deferred tax liability. So these are 2 specific instances which have come. And I'd also like to share with you that during this period, particularly April, May, the pressure has reduced a little. But again, last week it started. In fact, to be very honest, June was little more relaxing. But April, May, I was under substantial pressure, and it is again started now. There's a huge demand for diluting the standards. If there is a time when standards are more important, it is now. For example, when everything is good, take your own personal life example. When everything is good, little hygiene compromise here and there is fine. But when you have a situation like this, you have to be extremely careful in your hygiene. Washing hand means washing hand. So that kind of discipline important. Similarly, for all business entities, it is important that the factual position of financial status of the entity should be presented. If the assets value has dropped, you have to capture that drop in asset value. It will lead to a loss. It will lead to net worth erosion. But only if you present the true picture, you will get right investor and bank support. If it is not presented properly, that community will stay away. The financial reporting is a communication. The balance sheet, P&L and all is a communication. And accounting basically means accountability. And any communication, just like individuals, you and me, if someone communicates to you, I'm sure you want the person to communicate completely and truthfully. You will feel offended if somebody does not give you full communication or is not truthful. The same is true for the financial statements also. It is a communication, and that financial statement has to be only complete and truthful. In these times, small, medium enterprises are highly susceptible for survival. 10% GDP drop is given, which means 30 lakh crore of GDP is gone. And we saw last week, US GDP compared to Q2 last year is 32% down, 32% down. Global supply chain impacted. So with this kind of an overall environment, it is highly likely that almost all businesses will get impacted. Just as practitioners, we are impacted, businesses are all impacted. When you have this kind of a huge tsunami of economic impact following the pandemic, definitely businesses will get impacted. I would request each of the members here, please exercise very high caution in revenue recognition. My experience, of course, there are members senior than me, that in times like this, the risk of fraud is high. Please be careful in revenue recognition. If deferred tax assets have been created, those assets have to be reviewed and written off if required. Provisioning for impairment needs to be done, and importantly, going concern assessment. I would just like to conclude with a word of caution on going concern. I'm sure there are a few younger members here, and they will give me the benefit of my lost hair and my gray hair, apart from my gray beard. I'll take the liberty of sharing with you. Even in my 30 years of experience, I've seen 3 downturns, economic downturns, but all the 3 occasions, maybe impairment was there, but going concern assessment experience was not there. We didn't have instances where whether this business will survive 12 months, that assessment wasn't there. Now for every balance sheet you sign, whether it is 10 crore, 50 crore, whatever size, going concern is fundamental to your entire financial statements opinion formation. You are all aware, IBC cases in the last 3-4 years, banks had to take a haircut of 70 to 90%. All those cases, it is difficult to believe that the going concern assumption existed when they actually lifted their hands for IBC. Regulators will take strong action going forward, as banks have lost lot of money, and loss by banks is loss of money by public like you and me. So every IBC case, whether it's Alok Industries 75% or RCOM, that huge loss, it is your and my money which the banks have actually lost. They paid you and me 1% interest lower, 2% interest lower, because they had to bear that loss. It is you and me who have borne that particular loss of all those entities which have gone into bankruptcy, not somebody else. It is you and me as depositors. And many cases, the interest rate which we earn is less than the inflation rate, which means we are losing money even on the interest element. So going concern, my request to younger members, it's not easy to assess. It requires a deep understanding of industry, economy, and global trade. Please take advice of senior members. Please don't hesitate. That gray hair matters. That gray hair matters. Please take advice of senior members. They'll be able to guide you a little better on going concern. They might be able to ask some questions straightforward, which you may have some hesitation, and it might help you in concluding the right opinion. Thank you all for patient listening. Best wishes to all. Stay safe, stay responsible. Thank you all, and open to the Q&A.
Thank you, sir. Sir, Chinnamastan, sir, would you like to speak, sir?
Nothing, sir. You can go ahead.
మాట్లాడవే మాట్లాడే 4 మాటలు చెప్తావా ఇంతకు ముందే
Sir, inaugural, we done that so many things.
సరే ఓకే రికార్డెడ్ వెర్షన్ వింటా అయితే
Inaugural, మీకోసం వెయిటింగ్ సార్ అందరం అంతే చేయలేదు. సో 10 minutes కాకుండా ఒక 1 hour తీసుకున్నారంటే కొద్దిగా మేమంతా కాన్సెప్చువల్ గా స్టడీ అవుతాం.
Members, now question and answer session.
In fact, you should have Chins once again at Ongole branch
Yes,
for
sir.
specifically 3-4 standards like AS 22, 15, 28. I would request the branch managing committee or 2 hours program, no chief guest and all, only Chinnsamy, 3 standards or 4 standards you should do. But please feel free to ask questions. Use the benefit of Chinnaswamy's presence today.
Good, sir. We plan that, sir. Definitely we will plan without any inaugural, any meetings. We will do that.
Sir, for the current year, the turnover has come down by say 60 to 70. Now the units are operating at 25-30% capacity only. We have to consider how to view the going concern issue there. Now at present, some of the units, the granite units in Ongole are working with 25 to 30% capacity only. But the units are going on. Production is going on with limited staff and limited material, because the material is also not available properly, and labor also not available freely. But units are going on. Business is also going on. Sufficient orders are there. Still, we have to comment on the going concern. Simply, the production has come down.
Okay. Rajendra Prasad, there are 2 points. One is from the institute AASB, there is a advisory on going concern matter alone. Separate ga ok chinna advisory undi. It's available on the AASB website. It talks about how to assess going concern, and it also talks about the reporting requirements in the main audit report. What circumstance to qualify, it is there. In the example which you gave, in the example which you gave, మన గ్రానైట్ యూనిట్ ఒక్క సంవత్సరంలో క్లోజ్ చేసే పరిస్థితి లేని పక్షాన there is no need for a going concern issue. But if you feel there are some material uncertainties ఉన్నాయి, వీళ్ళకి కొంచెం లయబిలిటీస్ ఎక్కువ ఉన్నాయి, దే కెనాట్ పే, బ్యాంక్ లోన్ ఎక్స్టెండ్ చేయాలి, రీస్ట్రక్చరింగ్ అవ్వాలి, అలాంటి అన్సర్టనిటీస్ ఏమైనా ఉంటే ఆ అన్సర్టనిటీస్ ఫినాన్షియల్ స్టేట్మెంట్స్ లో చెప్పి నోట్స్ ది ఆడిట్ ఒపీనియన్ లోని యూ షుడ్ డ్రా రిఫరెన్స్ టు దోస్ అన్సర్టనిటీస్. అవి చేయాలండి, యూ హ్యావ్ టు డూ దట్.
థ్యాంక్ యూ సార్.
And there is one query in the chat box. Modifications in lease rentals require any reporting and financial statements? Answer is as follows. I'm assuming this question is for accounting standards. I'm assuming the question is for accounting standards. If it is for accounting standards, which is our AS 19, so those cases, the rent amount waived, either full waiver or partial waiver, it's an unpaid liability. That unpaid amount you will recognize as income in your P&L. So it will come as part of your other income. If it is material, make a specific disclosure. But if your question is in the context of Ind AS, you would have noticed 24th of July, an amendment to Ind AS 116 was notified, where it talks about an option given to the lessee on how to do the accounting for such rent modifications. That option is, you can treat it as a waiver, take it to P&L. But if that option is not exercised, what Ind AS 116 says is, whenever there's a restructuring of rentals, waiver, delay, all that, you have to remeasure your liability and then remeasure your total lease period liability and then calculate gain or loss and account the same. So that's in the context of Ind AS 116.
There are some small shop owners or some properties are leased out to various people. Now due to lockdown, they are paying only 50% or 25% of the agreed rent. It's only short-term phenomena. Whether we have to account the full rent and waiver, or we can simply account the net, because this is having implication both accounting standards and GST also.
Okay. Chinnsamy, you want to answer? Otherwise, I'll answer. Since
I will answer that, sir.
sure. Otherwise, I'm fine.
So you are asking in the context of a non-corporate entity. When we are talking about the non-corporate entity, the accounting standard on leases still remains as an operating lease. And when we are talking about the operating lease, we have two categories of lease. One is a cancelable lease and then non-cancelable lease. When we say it's a cancelable lease, for example, if the lease agreement says that there is a lock-in period of 5 years, up to which the lessor cannot ask the lessee to vacate. Or sometimes the agreement also says that the contract is for 11 months and either of the party can actually give you a notice of vacation or terminating the contract. In that case, it is not considered as a cancelable lease. Even in certain cases where we are seeing for other clients, where the lease agreement has been entered into as a 3-year period, but in that agreement, one of the clause says at any point of time, both the party can serve a notice of 1 month or 3 months and cancel the lease agreement. So in that case, the lease agreement is considered as a cancelable lease. In a cancelable lease, we don't know when that lease is actually going to be continued or where it is going to be closed. So accordingly, the waiver cannot be straight lined for the remaining period of the lease, because we don't know exactly what is the remaining period of the lease. Suppose if it's a cancelable lease, when I'm straight lining the entire lease payment over the lease period, for example, 5 years, it's a lock-in period. 5 years, when I am straight lining, the waiver will also get considered. That is what the normal accounting principle. As far as Ind AS 116, there is an option which has been given not to do it, and you can treat that as a different scenario. So when you are giving this 50%, if the waiver has actually been received from the landlord, or you are enforcing the force majeure clause, where you say that because of unforeseen circumstances, I am not able to pay. This is what majority of bigger companies have also sent notices saying that because of this, there is a clause on the rental agreement, force majeure, and force majeure clause based on which I was not able to do it because this is beyond my control. So if you are doing it, there could be a possibility of the remaining balance based on some litigation coming back to the P&L account. In that case, you can consider that portion as your contingent liability. Suppose the waiver has been agreed by the landlord, because in Chennai it's happening like that. They are worried, landlords are worried that they will vacate and terminate the contract in full. So they are giving the waiver. If the waiver has been confirmed, your outflow is actually only to the extent of that 50%. So that will only go to the P&L account because there is no liability for the balance amount. They have to see whether it's a cancelable or non-cancelable, and also waiver has been confirmed or not confirmed. And if it is not confirmed, whether you are ready for a litigation at a later point of time based on force majeure, then contingent liability disclosure is there. So you have to see the entire gambit, and then based on which you have to take a call.
So mutually agreed for the reduction in the rent.
A landlord is agreed.
Yeah, it is a landlord point only. I am talking about in the hands of the landlord, and both are mutually agreed.
Okay, then there is no further liability. So what is the actual income? You have to book that from the landlord's point of view and from the lessee's point of view. That is a person who has taken on rent. The outflow is only to that extent of the amount which has been agreed. So 50% if you are charging, that is enough, sir.
Whether we have to account for gross and reduce the waiver or
No.
only net income.
Net only.
Revised amount. No gross.
Simple. Make it simple, sir. Why we have to complicate too much?
Thank you, sir. Sir, we need some publication from the institute regarding signing of the provisional financial statement, signing of the assets and liabilities, whether to give or UDIN or not, sometimes projection, sometimes CMA certification. Every day banker will send so many certificates to the SSC, and simply they are telling some XY is signing, why your auditor is not signing. Even if you show any oral discussion, they are not accepting. Something is there as a guidance from the institute, then it will be helpful for everyone and a uniform policy can be adopted.
Okay. Rajan Prasad Garu, actually, this is a fairly hot issue now. At the Professional Development Committee, they are looking at what kind of clarification can be announced on this. But in parallel, there is also an engagement happening with Reserve Bank to tell the banks not to do this, because what will happen is if the banks keep asking, there will be some chartered accountants who will be vulnerable and they will sign. As a policy, provisional financial statements cannot be signed. As far as the projections are concerned, we have a standard 3400, based on which you can give an opinion on the financial statements. Now, as far as provisional concerned, there can be cases of review of historical information and all, but those again, you have to go through the formal audit process. Limited assurance is what you need to give. So this concept of 3 pages balance sheet P&L, putting rubber stamp, that is not allowed. That's not allowed, and that is not in the interest of the member also. It's not in the interest of members, because I know there are numerous cases where those provisional statements drawn from tally and all, they are not complete statements. Banks, in their eagerness for business, or businessmen working with the banks, those loans go. Reasonably good number of those loans, they end up in bad debts, and the banks unhesitatingly write to the institute for disciplinary action. And those cases are plenty. I would encourage exercising caution there, but I take your observation. I'll reiterate it again to the Professional Development Committee to accelerate that.
Thank you, sir.
Sir, one clarification, sir.
Sir, MPV sir, this is question from my side. You can actually throw some light, because the way in which they have asked me to structure the entire discussion is in the context of proprietary firms and partnership firms for tax audit. And recently there is an audit quality committee on tax audit. So you can actually give them some guidance on that.
That's a very important point. Good. Very important point. In fact, more than I think it's an important thing members should be aware. Institute, as all of you know, and all of you actually wish, that institute should be an effective regulator. I don't think any of us here want institute to be a welfare body or an association. We want our institute to be a regulator. It has to have that stature. And we want to have a regulator where we have a say and we can have the right kind of regulation. And for regulation, there are three elements. One is the quality of rule making, which is standard setting, AS, audit standards, ethics standards, etc. That is one activity of regulation. Whether it is RBI, SEBI, everyone does rule making. Second is oversight function. You have to keep seeing whether people are following those rules. The third is disciplinary function. So RBI does these three things, SEBI does these three things, IRDA does these three things, Institute also by Act does these three things. All others are other activities, but these are the main activities of the Institute. And in this context, the oversight mechanism, whether people are working as per quality requirement, you have peer review board, you have financial reporting review board, and during the presidency of our Mr. Manoharan in 2006, when the CA Act was amended, we had the quality review board also, which was introduced. In 2018, 2 years back, in the previous council term, we formed this body called Tax Audit Quality Review Board. The background of this is, in 2014, CBDT invited the C&AG to do an audit of the quality of tax audits. And it came out that the tax audit qualities was not meeting the objective of why tax audit was introduced. The objective of tax audit was to ensure qualitative tax computation and to ensure right fiscal compliance. But the C&AG audit, the outcome was that tax audits are not effective, and there is a huge demand saying that because tax audits are not effective, we should stop it off as well. So the institute fought it fairly hard with the CBDT and told, look, your opinion is based on a sample. It is not representative. So park that report for the time being. We are taking steps to enhance further the quality of tax audits. And in 2018, a board was constituted called Tax Audit Quality Review Board. What this board does is, through a random process, nobody has influence on that. You select our tax audit files. Currently, we are selecting larger ones. These tax audit files which are selected, you go give it to a reviewer who will review the file, and then there's a group who will review that particular report of the technical reviewer. Then it will come to the board. And if the board finds that the work there is negligence, then it goes to disciplinary. Otherwise, there is an advisory. I'd just like to draw your attention, and I would request all of you, if time permits, I think 7th, tomorrow, I think 7th, which is tomorrow, there is a program of the Tax Audit Quality Review Board on non-compliances, common non-compliances which have been observed in the reviews so far. So the chairman himself is going to speak on that program tomorrow. I'm sure mass mail has been sent from the institute. All of you would have received it. Time permitting, request you all to attend that. You'll get some insights on the common mistakes which are happening, and it'll help us avoid those mistakes in the work which we do this tax audit season. Thanks, Chins, for reminding me on this. There's the other member who was about to ask a question.
This COVID pandemic caused in the last month of financial year, sir, 1920. So for 1920 financial, there is no much change when compared to 1819. So shall we report this going concern concept for 1920 or for the year 2021?
No. 1920, the year was good.
Yes, sir.
But the going concern assessment, when you do on 31st March 20, you should do an assessment whether the organization will survive the next 12 months. So for 1819, it has rightly survived 1920. So on 31/3/20, you should make an assessment whether they'll survive the next 12 months, or is the entrepreneur having a second thought, whether he would like to take some alternate decisions. I'll give you some examples. I know a few people who have, for example, given some property on rent to some travel agent, to a hospital, etc., etc. Those people are telling, our shop, a cloth shop and all. Those people are telling, now I'm done. This year already 5-6 months gone. And despite all the pandemic, the inflation is there. In fact, RBI itself, we heard the governor speak saying that contrary to our expectation, inflation continues to be high because the demand supply issues are there because of supply issues. So there could be many of these small businesses who are doing textile shop trading, 20 crore turnover. He has some mortgage loans, etc. For all that we know, he may lift his hand. So we have to see on whether that business can now survive, or that entrepreneur himself may feel, I think enough, I'm done. I'm already 50, 55, 60, I'm done. My children, one child is in US, one child here, I'm done. I don't want to do. He might take those kind of decisions. So that is also a trigger for going concern. So based on that, decision needs to be taken. There is a question which I would request Chins to answer. This is available on the chat box. Interest on construction of capital asset, where borrowing cost continues to be capitalized to the asset. So your views. So there's a question from.
Sorry, sorry, Vice Chairman. I think that my chat box is not getting updated. Can you repeat that question so that I can?
Since it's come as a private message, so you cannot see it.
Oh, okay. Oh, that is the reason why I'm not getting that. Because when you say that a lot of questions are coming in, can you repeat, sir? I will actually respond.
The question, Chins, is during this period of COVID, somebody has borrowed money for construction, and construction is not happening now. Had construction happened, you would have capitalized. The question is, because construction is not happening, the borrowing cost, can we capitalize, cannot capitalize? That's the thing. I have the answer, but I thought you should.
Yeah. Friends, it's an obvious question because whenever COVID has come, the major question on borrowing cost is, can I capitalize even during the period where the suspended operation has happened? But if you see the advisory which has been issued by WASB as well as ASB on COVID-related matters, one of the point which they have also mentioned, and of course it is straight away coming from AS 16, is that if there is an abnormal delay during the construction period, you have to suspend capitalization of the borrowing cost. It should actually go to the profit and loss account. And accordingly, in the COVID-like situation where you could not do it, it is actually an abnormal delay. It is not an anticipated delay. When you are making your construction period, you also anticipate that our project will get delayed because of 1 month where there will be a huge rain or something like that. You have factored that. It is an anticipated delay, so there is no question of suspending this. But when abnormal delay happens beyond your control, and in that case, you are stopping your construction activity, necessarily you cannot capitalize that portion of the interest for that particular period. It should be actually charged to P&L. Unfortunately, no other alternative you have. In fact, one of the interesting question which we also had, sir, one of the client was mentioning about a depreciation. Can I stop charging depreciation during that particular 3 months or 4 months period? When we have seen that the client is actually a commercial client and not having any manufacturing or other activity, they have a single shift depreciation only charged under the Companies Act. Is that there is no question of you deferring it, because depreciation is not coming only based on your usage, but also comes based on your reflection of time, so you have to charge it. In another client case, it's a manufacturing industry where they have actually run only one shift, and the depreciation calculation has been done by the finance team based on the previous year, where in the current quarter, April, May, June quarter, they have said that they have operated a single shift only, and for 2 weeks they have not, 6 weeks they are not even operated because of lockdown in that particular location. We said for the entire period, you have to charge at least minimum 1 shift depreciation. But the extra shift depreciation will not apply for a simple reason. They are not actually worked, or the machine is not put on wear and tear. So this type of questions normally comes in because there is a pressure and the profits are actually coming down, sales is not happening, a workforce is not available, employees are not returning back to the work. With all these uncertainties, naturally, as you have rightly pointed out, the going concern assessment should be one of the important assessment the auditors has to make.
Correct. Any other questions from members?
Sir, on the lighter side,
Where?
our chart accountant identify going concern of the client very difficult, but the client easily identify our going concern.
I agree. They were very tough times actually, but in these times, everybody is going through. The unique part is no section of their society is spared, and every country in the map is affected, you know. And ila time loni em chestam inka just bhagantude edkondalu vade manalni kapadalli.
In fact, one of my friend who is a practicing chartered accountant, since his staff has refused to come because public transport is not there, every day he goes, picks him up and asking him to work in the office, and he drops back. That type of uncertainty we never expected in our life.
No, it will happen. It will happen, Chinnsamy.
Sir, now this RBI has given moratorium for 3 months and extended by another 3 months. Our client has taken that moratorium. What is the effect of, is there any effect at all on our accounting and reporting?
There is no effect per se. It's basically cash flow impact only. You are deferring the cash outflow. Otherwise, the interest will continue to accrue. And whenever the amount is due, it gets paid.
In fact, sir, we had a similar discussion in one of the NBFC where the RBI norms has been issued. What they have said was, as according to the RBI norms, the period for which the moratorium has been given, 6 months moratorium, they will actually factor that as an extended EMI. They will not even factor it as an additional amount to be paid on the EMI, because they believe that even a good account will become bad if that burden is actually being made. So if the loan has been given for 15 years, another 6 months will be extended. That's the way in which they will say. So there will be a component of additional interest which will be paid for that particular period where you have deferred it. So that has to be charged to your P&L account. That's what the NBFC, yeah.
From the extended period, and that's the thing which should happen. Unfortunately, for bank loans, RBI has limitation on restructuring loans. But even people like Deepak Parekh and all have requested or expressed an opinion that probably banks should be open for restructuring the loans before the loans actually become bad. It's almost like in everybody's life, 1 year in the calendar is gone, you know. Everybody's life, 1 year in the calendar is gone. So for the loan as well, you need to do that extension. But I think that's more a fiscal policy. So let them do their job, which they know it best. So thank you all, everyone. Any further queries? I think we have held you back for more than the scheduled time, and apologies for it. And apologies if I've spoken a little more than what I was supposed to also.
So thank you very much, sir. Thank you for all the members of Ongole branch and chairman, vice chairman and the office bearers for giving this excellent opportunity of addressing all of you on an important topic, and also for MPV sir to accommodate me in the Q&A session also. Thank you so much, sir.
Thank you, sir. I think this is the mega program, sir. After February, with your joining, it becomes a good interactive program. Sir, somebody can propose the vote of thanks, sir, from the branch.
Yes, sir. Yes, sir.
We can formally conclude.
Yeah, yes, sir. Yes, sir. We are concluding, sir. I think MPV sir, first time you are participating in Ongole, sir. Ongole seminar.
First time, Andy.
First time. Okay. So, this COVID has given this opportunity, sir. Otherwise, it may be difficult for us to catch you.
No, nothing like that.
No, because you people are very busy. So ours is a small branch, and
all of us are busy. All of us have enough work. It's just that how we want to balance the time. I think. Always a pleasure meeting people, and I'm happy. I saw 2 senior members. I'm very happy they took time and they stayed through the whole program. And thanks to Prasanna also. But he's been such a wonderful addition to the council. He's been doing exceptionally good work at the council, both on administrative matters and the technical matters as well.
Thank you, sir. Thank you. My members, they are almost 1 hour extended, sir. Still, there are 47 members. Total maximum is 52, and now there are 47 members are there still. So very interesting program, sir, for us at Ongole. We have enriched a lot, sir. Thank you, Speaker, sir, and thank you, Vijay Kumar, sir. Now I request our Sikasa Chairman, Baisan Jagamohan Rao, to propose vote of thanks.
Teacher garu unte students andaru untaru definitely.
Correct, sir.
Sir, we are all students, sir.
Second vote of thanks.
Okay. On behalf of Ongole branch, I am presenting vote of thanks. I thank firstly our Central Council member D. Prasanna Kumar Garu, who is son-in-law of this district, sir. That's why we are having very good relations with him, sir. And I thank you, Mr. MP Vijay Kumar Garu. First time he is coming and addressing Ongole branch, and he is nearly 1 hour you have spared with us, sir. We thank you very much for your enlightenment to the members of Ongole branch, sir. And similarly, with short time we gave, we requested our Chinnsamy Ganesan, and he has accepted our request with even 50 members only present, sir. We initially also we told you that we are having only less members and small branch. We have started our branch in the year 2016 only, sir, and we are actively participating in all the seminars and we are conducting. And recently we have shifted our branch also with new leased premises, and we are planning to go with own premises. Because of institute rules and regulations, we are unable to go for new premises, sir. We thank all the members of Ongole branch and speaker and our central council member, and particularly our regional council member Chinnsamy Ganesan. Sorry, sir, and both Chinno sir, sorry, sir, and our ex-officio member, and he is very giving encouragement to our members, sir, and with his enthusiasm and encouragement, we are working, sir. We thank you very much, all the members and central council members and regional council members and today's speaker, sir. Thank you very much.
Thank you.
Thank you, sir.
Thank you, Jagannath garu. See that lease agreement of new premises going concern. Right. Thank you.
Thank you.
Thank you, sir. Thank you, sir. జగన్ ఏం సంగతులు?
ఏంటి నాకు చెప్పకుండా ఇచ్చేసేస్తే
ఇందాక
అన్యాయం ఇది. అంటే
చూడు, ఒకసారి మెసేజ్ చూడు, ఫోన్ చూడు,
ఓట్ ఆఫ్ థ్యాంక్స్ నువ్వు చెప్పాలి కానీ, అందుకని నేను ఏం కవర్ చేయలేకపోయా కదా. ఓట్ ఆఫ్ థ్యాంక్స్
ఇంకా లాస్ట్ లో ఓట్ ఆఫ్ థ్యాంక్స్ అంత ఓపిక కూడా ఉండదు అందరికి.
ఇప్పుడు అట్లా కాదు,